Hi, this is Daniela Cambone, and welcome back to our summer series here on StansberryInvestor.com. We have brought back George Gammon of the Rebel Capitalist Show. George, always, I was gonna say it's been too long, it really hasn't, but we want to get more from you here. So welcome back to StansberryInvestor.com.
Thank you for having me back. I'm excited to be here.
Yeah, I want to get your thoughts on this influx of cash flooding the short-term markets like never before. Is this a bad sign? Wall Street is watching for signs of broader financial stress as trillions of dollars changed hands every night in reverse and repo markets. You've made a name for yourself as the repo guru experts. So I want to get your thoughts. Is this a bad sign here?
Well, I don't think it's a good sign. And I think you have to dissect exactly what's going on with the entities that are involved, right? So usually in the repo market, the transaction is between, let's say, a money market fund and a borrower, a hedge fund, let's say. It happens in the private sector. But when the Fed does a reverse repo or a repo, then the counterparty is the Federal Reserve. So let's just think this through. You've got almost $1 trillion a day, the last time I checked, of funds going to the Fed's balance sheet or going to the reverse repo liability portion of the Fed's balance sheet. So this means that, let's just say money market fund managers, because they're about 90 or 95% of the transactions, they're saying, okay, we've got $1 trillion. Now we can choose to have the $1 trillion be a counterparty, or excuse me, a liability of the commercial banking system. So they're our counterparty, or we can choose to have those dollars a liability of the Federal Reserve. So this is what they're implicitly saying, is that for whatever reason, we want that $1 trillion to be a liability of the Fed and not the commercial banking system. So why would they do that? Well, some people will say because they're just overwhelmed with cash and the Fed increased the reverse repo rate to 5 basis points from 0, and this incentivizes them to go in. Maybe that's possible, but you also have to look at the fact that it very well could be that the amount of counterparty risk in the private repo transactions has increased significantly to the point where those money market funds would rather have that $1 trillion a liability of the Federal Reserve. That's kind of the dynamics that are at play, and I think that's what most people need to pay attention to.
George, we're also speaking ahead of the great big Jackson Hole reunion here. What do you think will be at the top of the agenda here for the Fed?
Brainwashing us to try to get us to do what they want us to do, and that's go further out the risk curve and buy stocks. That's what this is always about. The Fed really, at the end of the day, doesn't have too much control. They like to assume or like to think that they do. They like us to believe that they have control over the dollar, as an example, but they really don't. And so what they do have control over is expectation policy and market psychology. So I think they gather as a group and decide what their narrative needs to be in order to get the market to do their bidding for them, whatever they want to achieve. And so that's what you're going to hear. You're just going to hear more narrative. I was listening to my good buddies, Jeff Snyder and Emil Kalinowski, and I would have to defer to them because Jeff is the repo expert in reality. But they came out with a very good saying that the Fed doesn't supply money. The Fed supplies narrative. And that's what people have to get their mind around, because the only thing that the Fed can really do is create bank reserves. And although those bank reserves are denominated in dollars, they're not really the dollars that circulate in the real economy. Now they can be if they're monetizing the government's deficit spending, but usually those dollars that circulate in the real economy, and the way I look at it is the dollars that are on the balance sheet of non-bank entities like you and I. Those are created by the commercial banking system. The Fed doesn't control that money, quote unquote, right? Again, what the Fed controls is narrative. And once people get their mind around that, they see that the emperor is really wearing no clothes. And the market hasn't gotten to that point where they realize that they're being played. At some point, I think they will. Maybe that point was back in March of 2020, when I believe we went from a Fed put to a government put, meaning the market was reliant on quantitative easing, but now they're more so reliant on government deficit spending. That could be a different direction. But again, the main point is they're going to focus on whatever narrative that they want the market to digest.
So George, let me ask you, if they are focused on the narrative, right? And if they're going to be doing everything to keep the allure of the stock market alive, when I have experts coming on saying, you know, the market's going to crash, this is going to end ugly, well, won't this just defer this from happening if they're going to want to keep the party going on longer here?
Yeah, it can. Again, it depends on if the market participants buy the narrative, and that is that the central bank is actually central. And I'm sure they can kick that can down the road, but I think that the people watching this video that are interested in building and preserving their wealth need to ask themselves, can the market crash up? And what I mean by that is most people think about a stock market crash as the stock market going down in nominal terms, but they don't realize that the stock market can crash up.
A melt up.
A melt up. Well, what an example would be Venezuela. That was the best performing stock market potentially in human history. It's going up 10,000% a day. But the fact is that stock market, or those stocks that you own, are denominated in bolivars, and you're losing more purchasing power, even though the nominal price of the stock is going up. So I would ask everyone, look at your portfolio. Look at what your portfolio has done, let's say in the last year, okay? Maybe your portfolio has gone up by 5%. Maybe it's gone up by 10%. Maybe it's gone up by 15%. But now I would ask you, how much is the price of the stuff that you buy at the grocery store gone up over the last year and a half? How much has your rent gone up? How much has just getting a rental car? I just got a rental car this weekend. How much has the price of that gone up? How much has the price of going out to a restaurant gone up in the last year and a half? You see, so this is an example of, yes, the market can be going up, but you may still be losing purchasing power at the end of the day.
Right.
It's all about purchasing power.
Right.
It's not the nominal
Right.
value of your portfolio.
Right. Such a good point. So to that, let me ask you this. Would you prefer for a short term having to pay, or deal with 4 to 6% inflation, although I would beg to differ, it's way more than that right now, or recession? Or is there a middle road? Or are those the only two options?
At some point, you got to pay the fiddler. So you have to have a deleveraging because of the amount of debt in the system. The question, is it a deflationary deleveraging or an inflationary deleveraging? But what you're dealing with is an economy that's addicted to monetary heroin. It's addicted to a drug. So you've got to look at it the same way. So is there an easy way for a heroin addict to get clean and sober? No, there's not. You got to go through significant amounts of pain. You got to go through that withdrawal process of not having the heroin. And at some point in time, the US economy, and the Western economy for that matter, is going to have to go through that process of withdrawal to get back on stable footing.
But George, which Fed chair is going to want that on their history books?
Well, they're not. So most likely the release valve is going to be the dollar. I mean, I think that if you took them out to dinner and you give Jerome Powell a couple glasses of whiskey and you say, hey, what's your perfect game plan here? He would probably point out something like the 1970s, where we go into the 1970s with, I don't, right off the top of my head, I think we're at 65% debt to GDP as far as the government. And we come out of the 1970s at, let's say, 30% of debt to GDP. So we cut the debt to GDP in half. I think that's his kind of perfect scenario, where you keep the long end of the curve suppressed. You have negative real rates for a period of, let's say, a decade, and somehow you manage to keep inflation in check to where it doesn't proceed to some sort of hyperinflation type of event, which is a huge risk. But then, you kind of land that plane, and in a decade, we look back and debt to GDP goes from, let's say, 130 or 40% back down to 70%. And the balance sheet for the corporations and the private sector has all improved. I think that's kind of the perfect scenario for them. The problem with that is there are a lot of factors at play. There are a lot of cross currents. There are a lot of variables, and you just can't micromanage an economy. And usually when governments try to implement that strategy, there are a lot of unintended consequences.
You know, I just had a fascinating conversation with Larry Lindsey, who was an advisor to George W. Bush. He just put out a book called Currency War. Anyways, he was also sat on the board of the Fed. And when I asked him about, you know, a gold standard, it's the 50th anniversary of us getting off the gold standard.
Yeah.
And he kind of had some insights he revealed saying, you know, why would the Fed ever like a competing product to the fiat?
I don't know any company on earth that loves its competition. I mean, that isn't what you do. And gold is a way of voting no against the dollar. And so, no, they don't like gold very much at all.
So I just want to get your thoughts. You know, it's like I said, the 50th anniversary of us going off the gold standard. Do you think we would have been better off still being on a gold standard given today's economic environment, George?
Absolutely. We have to have some sort of monetary constraint, because at the end of the day, we're imperfect human beings. And so regardless of what that monetary constraint is, that's what we need. And gold, to a certain degree, achieved that. But now the problem with that is that the governments just said, oh, we want to go to war, let's just abandon that gold standard thing. You know, or, oh, we need to fight the COVID emergency, let's just go ahead and abandon that gold standard. You see, that's the problem. But yes, ideally, we would have some sort of constraint on the money supply to let the free market really work. And in a free market environment, you know, prices go down. That's a healthy economy. That's how the consumer, that's how the average Joe and Jane, the poor and middle class, increase their standard of living. It's through deflation. It's not through inflation.
George Gammon, really good thoughts from you as usual. We will be watching the Jackson Hole meeting closely, as I'm sure you will be, and then we'll reunite and discuss and break it down.
Yeah, and one thing that sounds great. One thing I'd advise your viewers when you're watching the Jackson Hole, the proceedings, make sure you start paying attention to how often they reference a central bank digital currency, because that's the direction I think we're going. That's how they're going to get control of the dollar, and that's how they're going to create the inflation they need.
Absolutely. Really good point. We'll be watching that closely. George Gammon of the Rebel Capitalist, thank you. Come back anytime, stansberryinvestor.com.
Thanks for having me.
And thank you all for watching. We'll have much more for you. Be sure to stay tuned. In the meantime, don't forget to register for premier content, free, that you can't get anywhere else at DanielaCambone.com. That's it for me. Thanks for watching.